Hi everybody, this is Phil Holoka from Complete Captive Management Services, and I can't think of a better way to ring in the new year than to talk about tax. So today we're going to talk about how captive underwriting profits are taxed. Now this discussion is a high-level theorem discussion. You can't take what I'm going to say here and apply it to your situation, because your situation may allow for tax planning attributes that are more specialized and customized to your needs. This section up here is pretty simple, but when we talk about the long-term capital gains, boy, that is very much customizable to each individual employer. So, at a high level, let's talk about premium. So your captive has collected $1 million of premium. Is that $1 million taxed? Well, yes, it is. If your captive is fronted by an admitted carrier, that carrier has to pay state premium tax in every state that it's admitted to place insurance. And that tax rate is usually 2-point-something% of $1 million. In addition to that, the domicile that your captive is domiciled in is also going to pay a tax based on this $1 million. So in total, you're looking at 3-point-something in total tax on $1 million. Now that 3-point-something is baked into this number, the SG&A expenses, sales, general, and administrative expenses, and then claims that are paid from the captive. So let's assume that there's $800,000 of claims that have been paid. You reduce the million by $800,000, leaving you with $200,000 of underwriting profit. Now this tax calculation is very simple. Your captive is a C corporation in the eyes of the IRS. It's going to file a 1120 PC tax return. And we know that C corporations pay a 21% tax rate as of the filming of this video. So you simply take 21% of 200, you get 42 grand. That's your tax expense. Then that leaves 158,000 of retained earnings or profit. Now, let's assume that the captive board of directors declares a dividend. They're going to declare a dividend of $158,000. Now, I don't know how that's allocated, but let's just make it simple and allocate 1/4 of that 158 to all 4 of the clients, all 4 of the members. So that means member number 1 is getting $39,500, as is member number 2, member number 3, and member number 4. Now, member 1, 2, and 4 are for-profit entities, and member number 3 is a non-profit entity. So, the income that each one of these members receives is going to be most likely classified as long-term capital gains. And long-term capital gains has a scaling tax rate. This scale depends on what your underlying corporation's profitability is, generally. So let's assume this member is small and pays no long-term capital gains. They get $39,000 of profit. Member number 2 is paying 15%. They're walking away with $33,575. And member 3 and 4 are walking away with $31,000. Now you're going to say, no, wait a minute, Phil. Member number 3 is nonprofit. They're not a taxpayer. Well, when they're investing in a captive insurance arrangement, this income is most likely going to be deemed unrelated business income, because this nonprofit has a mission, and their mission is to do something for the public. If they're bringing in income that is outside of the mission of the nonprofit, that nonprofit can't not declare that as income. Therefore, this is taxable. Now, Sometimes you can offset long-term capital gains with long-term capital losses. So there is opportunities here for customized tax planning. But for a high level, the takeaway is the captive's taxed and then the member's taxed. So why can't you do something else to escape this? Well, what about reducing next year's premium cost by this value? Well, if you're fronted, the fronting carrier's not going to really care about this because the fronting carrier is pricing your policies based on your risk, not based on the profitability of the captive. So this one here is probably a non-starter. What about a premium holiday? Well, you could do that too, but that's kind of like bartering. You're bartering with your captive and the carrier, and bartering is a taxable event. Okay? So you can't really do this effectively either. How about let it ride? This guy says, no, I don't want my $39,000. I want to keep it up there. Well, that's not a good idea either because this $39,000, if it's kept up here, is exposed to third-party loss, which means at some point, if the captive has a bad year, they could never receive the $39,000. There are other things that you can do, but it really depends on the structure. And that's where you need to engage a captive manager and a tax consultant to define what your corporation's needs are so you can invest in the right captive structure and solution. So, hope this was helpful. Happy New Year to everybody. We'll talk to you next week. Bye now.